Our topics for tonight, we will spend most of the evening on cash to accrual conversion, and hopefully you've had an opportunity to view the video on this subject. It'll make your understanding tonight a lot easier, and hopefully you'll have some questions that you have brought with you. And then I'm going to provide you with some academic advisement about your program and try to answer any questions you might have. Let me once again define cash basis and accrual basis. You'll recall I said cash basis recognizes revenue when and only when cash is received, and expenses are recognized only when cash is paid. Accrual basis, revenues are recognized only when earned. It doesn't matter when the cash is received. And expenses are recognized when they help to produce a revenue. It doesn't matter when the cash is paid. So tonight, you're going to learn how to convert from cash basis to accrual basis. Why do I cover the subject of converting from cash basis to accrual basis? Well, there are a number of reasons. One day in the future, someone might bring you a shoebox full of receipts, invoices, and canceled checks from which you will be asked to prepare financial statements on an accrual basis. Another reason is that a business using cash basis may want to obtain a loan, and the bank will probably require a set of audited accrual basis financial statements. And so it'll be necessary for you to convert the financial statements from cash basis to accrual basis. A third reason is this will also help you when we cover the cash flow statement later in the semester, in which you will do the opposite. At that time, we will convert from accrual basis to cash basis. But the most important reason is that converting from cash basis to accrual basis improves your ability to analyze and record transactions. Also, this material is the most difficult we will cover in Accounting 350, and therefore, this will give you a glimpse at the level of difficulty that you will find in Accounting 351 next semester. Here is an example. This is a set of journal entries that we are going to record in year 1 and year 2. And we will find accrual basis revenue by converting from cash basis revenue. In year 1, we have a cash sale for $100. This is both a cash basis and accrual basis sale. It is a cash basis sale because cash is being received. It is an accrual basis sale because the cash received from the customer has been earned. We also had a credit sale for $50. This is only an accrual basis sale because no cash is being received. As you can see, our cash basis revenue from these transactions is $100. And our accrual basis revenue is $150. Notice that the only difference between accrual basis and cash basis in these two transactions is the $50 that accounts receivable has increased. This $50 is a revenue for accrual basis, but not cash basis. In other words, the reason that accounts receivable increases is the result of a credit sale, and therefore an accrual basis revenue is recognized. But what if we weren't able to see these journal entries? If all we knew was that the cash basis revenue is $100, how would we find accrual basis revenue? The answer is we would examine the beginning and ending balance for accounts receivable, and we would see that accounts receivable increased $50. Therefore, we would start with cash basis revenue of $100. We would add the $50 that accounts receivable increased, which would then result in accrual basis revenue of $150. But why do we add the $50 account receivable increase? The reason is because the accounts receivable of $50 was created by the credit sale, which is recognized for accrual basis, but not cash basis. As a result, we add the $50 because that $50 was an additional accrual basis revenue that was not included in the cash basis revenue of $100. This accounts receivable increase that you see here, this is how we are going to describe the conversion from cash basis to accrual basis tonight. In year 2, let's assume we have a cash sale for $120 and $50 of accounts receivable is being satisfied that had been recorded in year 1. Okay, so we're assuming that $50 is now being satisfied in year 2. As you can see, our cash basis revenue is $170 in year 2, and our accrual basis revenue is $120. Notice that the only difference between accrual basis and cash basis is the $50 that accounts receivable has decreased. The $50 is a revenue for cash basis, but not accrual basis. In other words, the primary reason accounts receivable decreases is the result of cash being received from a customer to satisfy an account receivable, and therefore a cash basis revenue is recognized. Once again, if all we knew was that cash basis revenue is $170, how would we find accrual basis revenue? The answer would be to examine the beginning and ending balance for accounts receivable, and we would see that accounts receivable decreased $50. We would start with cash basis revenue of $170. We would subtract the $50 that accounts receivable decreased, and then find accrual basis revenue of $120. But why do we subtract the $50 accounts receivable decrease? The reason is because the cash of $50 that was received is a revenue for cash basis, but not accrual basis. As a result, we subtract the $50 from the cash basis revenue of $170 because that $50 should not be included in the accrual basis revenue of $120. Let me then summarize the reason that the $50 increase to accounts receivable is added in the year one example is because this journal entry is for a credit sale that recognizes an additional revenue for accrual basis that isn't recognized for cash basis. In other words, the $50 is not included in the $100, but it should be for accrual basis, and that's why we add it. The reason that the $50 decrease to accounts receivable is subtracted in the year two example is because this journal entry is for cash received to satisfy an account receivable and is recognized as a revenue for cash basis that is not recognized for accrual basis. In other words, the $50 is included in that $170, but it should not be included for accrual basis revenue, and that's why we subtract it. Let's look at a few additional transactions and then convert from cash basis net income to accrual basis net income. Now, notice I said net income. Here, we're not just going to deal with revenues. We want to see what the effect is. How do we convert from cash basis net income to accrual basis net income? So if we look at this transaction, which was part a cash sale and part a credit sale, the cash basis revenue is $2,000 and the accrual basis revenue is $3,000. So part of this sale was cash and part of it was on credit. So the $2,000 represented the cash basis part, and the $3,000 was the total sale that represented the accrual basis revenue, part of it being cash, part of it being a credit sale. Next, let's assume an expense that is part cash and part credit. In this example, the cash basis expense is $700 because that's the amount of cash that was paid. And the accrual basis expense is $1,000. It's the total cash of $700 and the liability part of the expense totaling $1,000. This results in cash basis net income of $1,300, and we get that by taking the revenue minus the expense. Again, that gives us $1,300. And accrual basis net income of $2,000, subtracting from the revenue $1,000 of expenses. So you can see here, we would have, under a cash basis, recognized net income of $1,300. And under accrual basis, our net income would have been $2,000. What if we weren't able to see these journal entries and all we knew was that cash basis net income is $1,300? How would we find accrual basis net income? Well, first of all, we would have taken the accounts receivable. We'd look at the changes. Notice that the difference between cash basis net income and accrual basis net income are the changes in accounts receivable and accounts payable. So we would add the increase in receivables and subtract the increase in the payable. and that would give us our $2,000. So the question again is, why do we add the accounts receivable increase and subtract the accounts payable increase? And as you saw on the previous slide, the increase in a receivable is the result of an accrual basis revenue, which increases accrual basis net income. It has no effect on cash basis. And the increase in a payable is the result of an accrual basis expense that reduces accrual basis net income. So as you can see, both of these examples, the receivable and the payable, these only affect accrual basis and not cash basis. And therefore, we have to add an additional revenue of $1,000 to the $1,300 because we are looking at accrual basis net income. And we subtract the $300 increase to the payable because, again, that represents an accrual basis expense. It is not a cash basis expense. So we treat it as an additional expense and subtract it to get to our $2,000. These last two slides are extremely important, this one and the previous one. They are the key to understanding the rest of tonight's lecture. So if you don't understand what we did in these two slides, you need to review the recording of this lecture as many times as necessary. Let's look at the most common differences between cash basis and accrual basis net income. Here are some examples when cash basis net income is equal to accrual basis net income. That would be true for cash sales and any other cash revenues. It would also be true for any cash expenses. Cash basis net income will be greater than accrual basis net income for these kinds of transactions. Anytime you have unearned revenue, remember what causes revenue to be unearned? It means you received cash in advance before it was earned. Well, if you're receiving cash, cash basis net income is going to be greater because we'll recognize that as a revenue for cash basis, but it's not a revenue for accrual basis. Anytime you have a credit expense, those expenses will be recognized for accrual basis, but not cash basis, and therefore accrual basis net income will be less than cash basis. And finally, anytime a receivable is satisfied by a customer, that means that cash is being received, which causes cash basis net income to be greater because it is recognized as a revenue, but it is not a revenue for accrual basis. And examples of where cash basis net income will be less than accrual basis net income, anytime there is a credit sale, okay, that'll be recognized as an accrual basis net income, but not cash basis. Prepaids, meaning cash paid in advance, that will be recognized as an expense for cash basis, but not accrual basis. Their cash basis net income will be less because we are recognizing an expense for cash basis. And anytime a liability is satisfied, such as a payable, that would mean that we are paying cash, and that would be treated as an expense for cash basis, but not accrual basis. If you go through these examples, you start to get a feel for what affects cash basis, what affects accrual basis, and what affects both cash basis and accrual basis. Okay, here are some examples of how different transactions affect cash basis and accrual basis. Let's start with the first one, a cash sale. Okay, that will affect both accrual basis and cash basis. A credit sale. A credit sale only affects accrual basis net income. Cash collected for accounts receivable to satisfy a receivable. only affects cash basis because of the cash being collected, does not affect accrual basis. Cash received in advance of earning it. Okay, this again will only affect cash basis, revenues, and net income. And as you know, we refer to this as either deferred revenue or unearned revenue. Advanced cash that's been earned. In other words, cash received in advance that has now been earned. So now we're recognizing an accrual basis revenue. That would mean that this unearned revenue now has been earned and is now recognized only for accrual basis, not cash basis. Cash paid in advance, in other words, prepaids. In this example, we're paying cash, so it would be only affecting cash basis. And in this case, it would be a cash basis expense. These would be all of the prepaids. And finally, a prepaid asset that has been used. In this example here, we created the prepaid. Now that asset is going to be used, so it would affect only accrual basis expenses and net income, because we are going to expense any prepaid that we've used, such as supplies. And so again, this would be a prepaid that has been used. These are all good exercises for you to go through to make sure you understand what affects cash basis and what affects accrual basis. And it'll make it easier when doing the conversions from cash basis to accrual basis. You'll recall earlier in the semester when we looked at the relationships between assets, liabilities, revenues, and expenses. You learned that most often a revenue creates an asset and an expense either creates a liability or uses up an asset. Almost all of these assets and liabilities are going to be current. We can describe the same relationships in a slightly different way. For example, assets are created by revenues. And what kind of assets would those be? Well, they'd be cash, accounts receivable, and other receivables. Those would be examples of the kinds of assets that have been created by a revenue. Liabilities are created by expenses, and the kinds of liabilities that are created would be accounts payable and other payables that are created by expenses. Assets are used up by expenses. That was another possibility. And those assets that are used up would be cash, supplies, and inventory. Liabilities can be created by the receipt of cash. For example, unearned revenue and a note payable. These are all examples of liabilities that are created by the receipt of cash. Assets are created by the payment of cash. For example, when we use cash to purchase supplies and inventory. If you look at all of the examples here, every one of these are current assets or current liabilities. Therefore, to find our revenues and expenses, we only need to find the changes in current assets and current liabilities. That's how we convert from cash basis to accrual basis. And I'm going to go through a lot of examples tonight in which we analyze current assets and current liabilities to convert from cash basis to accrual basis. To convert from cash basis net income to accrual basis net income, as I just said, we only need to adjust for changes in current assets and current liabilities for the increases and decreases. So we're going to look at each current asset and current liability, determine whether it increased or decreased, and see what effect that has on converting from cash basis to accrual basis. And tonight, I'm going to use a term, unexpense, that I made up years ago and which we will be using. Unexpense means we treat net income as though an expense was not recorded. Okay, means we pulled the expense out. And of course, with less expenses, net income will increase. So let me repeat that. If you remove an expense, that causes net income to increase because of less expenses. And I, as I said, refer to that as unexpensing. And you'll see how we do that tonight. Here's an example. Let's say net income is $100,000 and it contains an expense of $1,000. If the $1,000 is unexpensed, meaning we remove the $1,000 from the net income of $100,000, our net income is now going to be $101,000 because we have $1,000 less of expenses. Well, the easiest way to unexpense this would have been to take the $100,000 and just add the $1,000. There are three questions that should be asked and answered when analyzing a conversion from cash basis to accrual basis. These are the three questions, and we'll be asking these tonight and answering them. First question, does the current asset or current liability increase or decrease? You can go to a balance sheet that has the ending balances for 1 year, and you can go to the balance sheet for the previous year to see those ending balances, which then become the beginning balance of the current year. And you'll see the increase and decrease in current assets and current liabilities. Second question, what kind of journal entry creates that increase or decrease? And the third question, does that journal entry affect cash basis or accrual basis? Now, once you've asked these three questions, what we then do is come to the following conclusion. If it affects cash basis, we remove it. If it affects accrual basis, we definitely want to include it because we are looking for accrual basis, net income or revenues or expenses. The first asset we'll look at, and that's accounts receivable. The blue font represents accrual basis, and the red font represents cash basis. Let's assume an increase in accounts receivable. The first question is, did it increase or decrease? Well, here we are being told accounts receivable increased $1,000. Second question, what kind of journal entry would be recorded in order for accounts receivable to increase? And using T accounts, it would be the result of a credit sale, which we debit accounts receivable and credit sales. Therefore, the third question was, does this kind of entry affect cash basis or accrual basis? Well, since we don't see cash in this transaction, this is strictly an accrual basis entry. It only affects accrual basis revenue. If we were to start with cash basis sales of $50,000, what would we do to convert it to accrual basis sales? If this affects accrual basis, but not a cash basis, then we have to include it. This $1,000 is not included right now in the $50,000. So in order to find accrual basis sales, we have to add it as an additional revenue for accrual basis sales. What about net income? Well, let's assume that our cash basis net income was $3,000. We know that that $1,000 only affects accrual basis. Therefore, it is not included right now in that $3,000. But it does represent an additional increase of net income for accrual basis. And so we would add it, and that would increase our accrual basis net income to $4,000. Next, let's look at what happens if accounts receivable decreases. Again, this is very similar to those journal entries I showed you at the beginning of class, where we also had a decrease in receivables. Our second question that gets answered is what kind of journal entry and transaction would result in a decrease in receivables? The answer is that we are receiving cash to satisfy a receivable from a customer. And then the third question that we answer is, does this journal entry in which we're using T accounts, does this affect cash basis or accrual basis? And here, obviously, it affects cash basis because cash is being received, which we would consider to be a revenue for cash basis. And then you'll recall we said if it affects cash basis, we should remove it. We should exclude it because it is not going to be part of accrual basis. And so what we would do, again, if we start with cash basis sales of $50,000, and we said we need to exclude it because this revenue of $1,000 for cash basis, which is in the $50,000, we have to remove it so that our accrual basis sales are only $49,000. And as far as cash basis net income, again, we exclude it from that $3,000 to get to our accrual basis net income of $2,000. Prepaids. Let's start with the assumption that our prepaid increased $1,000. In this case, the prepaid could be supplies or any other kind of prepaid asset. Here, I'll just call it a prepaid. What kind of journal entry would cause a prepaid to increase? Well, it means you used cash to purchase the prepaid. And then the third question was, does this kind of journal entry using T accounts affect accrual basis or cash basis? Well, the answer is very obvious. Since we paid cash, that affects cash basis and would be treated as a cash basis expense. If we start with cash basis expenses of $50,000, in that $50,000, we've already subtracted out this $1,000 as an expense. The expense that we included in the $50,000 cannot be treated as an expense for accrual basis. Therefore, we remove that expense so that our total expenses are only $49,000. And if we look at our cash basis net income, this is an example in which we will unexpense that $1,000 and therefore add it back to increase accrual basis net income. Remember earlier, I said when you unexpense, you're removing that expense. So in this $3,000 of net income, $1,000 of expenses cannot be used for accrual basis. Therefore, we unexpense it. That's going to cause net income to increase. And the easiest way to do that is just add back the $1,000 to give us accrual basis net income of $4,000. This $4,000 now does not include this $1,000 of cash basis expense. Let's look at a decrease in the prepaid. This is how we would show a journal entry for expensing, meaning using up a prepaid. such as supplies. Debit the expense, credit the asset. Starting again with cash basis expense, notice here that this kind of entry, this kind of journal entry, does not affect cash basis, but it certainly affects accrual basis, meaning this would be an expense of $1,000 that is not included in the $50,000, but it's an additional expense for accrual basis. And so as a result, we would add it as another expense to accrual basis expenses. And as far as our net income, because it is an additional expense that was not included in the $3,000 here, we would subtract it, because it is an expense, to reduce our net income down to $2,000. In other words, this $1,000 here of expense would be another expense that we would recognize for accrual basis to decrease our net income. Okay, moving on to accounts payable. This is a current liability. And we'll start with the assumption that accounts payable increased $1,000. And as you know, the type of transaction, journal entry, that would cause accounts payable to increase, it would be to debit a credit expense that resulted in an account payable. As you can also see, this would affect accrual basis, but not cash basis. And therefore, whatever effect it has, we want to include it because we're looking for accrual basis. If we start with cash basis expenses of $50,000, this $1,000 is not included in the $50,000 of cash basis expenses. So we need to add an additional expense of $1,000 to arrive at our accrual basis expenses of $51,000. As far as net income, this expense is not included in the $3,000 because it doesn't affect cash basis, but it does affect accrual basis net income, and therefore we have to include this additional expense, which means, like any expense, we have to subtract it, and therefore it will decrease our net income for accrual basis, and that gives us our $2,000. As far as an accounts payable decrease, the kind of transaction that would result in a decrease would be to satisfy a payable, in which we debit the payable and credit cash. Because we are paying cash, that would be an expense for cash basis, but it would have no effect on accrual basis. Therefore, because it only affects cash basis, we want to exclude it. We do not want to include it as part of our accrual basis. So this $1,000 of cash basis expense is included right now in the $50,000, but we don't want to include it. We want to exclude it when we determine our accrual basis expense. So all we have to do is subtract it, remove it. And therefore our accrual basis expenses will be only $49,000. For net income, that $1,000 of expenses included in cash basis net income of $3,000, but we want to exclude it. And here's another example of unexpensing it. We want to unexpense the $1,000. And as you saw earlier, the way we unexpense an amount is just add it back. And that's the same as removing it. And so we would add the $1,000 to give us $4,000 of net income. In other words, by unexpensing it, it increases net income because we have one less expense included in our net income. Let's move on then to another liability, unearned revenue, or the other name for it is deferred revenue, we'll start with the assumption that our unearned revenue increased. And so we answered the question, what kind of transaction or journal entry causes unearned revenue to increase? And that would be the result of receiving cash in advance of earning it. And as you can see here, if we receive cash, then for cash basis, we treat this as a revenue. It has no effect on accrual basis revenues. For accrual basis, it's only a liability. And so starting again with the $50,000, in that $50,000 is this $1,000 of revenue. It's included in that $50,000, but it shouldn't be when we are determining what our accrual basis revenue should be. Therefore, what we do is we remove it, we exclude it, subtract it out to get to accrual basis revenue of $49,000. And as far as our cash basis net income, again, notice that for cash basis, this is a revenue that was included in the $3,000, but it is not a revenue and cannot be recognized as a revenue for accrual basis net income. So we remove it, we exclude it, we subtract it to get to accrual basis net income of $2,000. Now, if we look at a decrease in unearned revenue of $1,000, we look at what kind of transaction would cause a decrease. And here you can see that $1,000 of the unearned revenue has been earned, and therefore we record it as a sale. In this case, we're using the sales account. This does affect accrual basis sales and net income. So if we start with cash basis revenue of $50,000, this $1,000 of additional revenue is not included in the $50,000. And so we'll add an additional revenue of $1,000 from this decrease in unearned revenue, and that will give us accrual basis revenue of $51,000. And as far as net income goes, this $1,000 is not included in the cash basis net income of $1,000. So we will treat it as an additional revenue to increase our net income. And that would give us accrual basis net income of $4,000. Inventory is a little tricky. Think about the example we did on prepaids, because in inventory, we don't call it a prepaid, but it really is very similar to a prepaid. So whatever we did with prepaid, we're going to do the same thing with inventory. It's just we're going to use different account names. We're also going to make an assumption here. In our example, we are going to assume that any purchase of inventory was made using cash. So every purchase was a cash purchase of inventory. Now, that's not very realistic in practice in the real world, because most inventory is purchased on credit. But we can make that assumption here in our analysis, because if we overstate the cash purchase of inventory, that's going to be offset by any understatement of our payables that would have resulted from a credit purchase of inventory. And the next slide, which we're not going to spend any time on, is proof that we can make this assumption that all of the purchases of inventory were made with cash. So let's start here now with inventory, beginning with an increase in inventory of $1,000. And the kind of journal entry that would cause inventory to increase, again, depending on which inventory system you're using, we would debit inventory if we're using the perpetual inventory system, or we would debit purchases if we were using the periodic inventory system. What's important here is the credit. The credit here is to cash, based on our assumption that all purchases of inventory are going to be for cash. If we're paying out cash, then that becomes an expense for cash basis. And therefore, if we start with the $50,000 of cash basis, and in this case, the expense is going to be cost of goods sold, then this $1,000 is already included in the $50,000. And because we are looking for accrual basis, we can't include this expense or this cost of goods sold, and therefore we have to remove it to find our accrual basis, cost of goods sold. If we look at cash basis net income, that $1,000 is included in the $3,000. But because we can't include it, we must exclude it to find accrual basis net income. Again, another example of unexpensing the $1,000, which means we just add it back, remove that expense, and that's going to cause our accrual basis net income to be higher and result in accrual basis net income of $4,000. If you compare this to what we did with prepaids, you're going to see the same effect. It's just we're using different account names here for the debit side of the journal entry. Okay, then this last part is where inventory decreases. To cause inventory to decrease, it means you are selling merchandise and decreasing your inventory. So my credit would be to inventory, doesn't affect cash. Notice what my debit is. If I'm using a perpetual inventory system, you'll recognize this from earlier lectures where we debited cost of goods sold. For a periodic inventory system, you see here income summary. What this really should say, retained earnings. Starting with cash basis, cost of goods sold of $50,000, because this is an accrual expense, meaning in addition to cost of goods sold, it's not included in the $50,000. There's no cash involved here. Therefore, we'll have to add it as an additional cost of goods sold to get to $51,000 of cost of goods sold. And then finally, the $3,000 cash basis net income does not include this additional $1,000 of cost of goods sold, but it should, because we're trying to find accrual basis net income. Therefore, what do? We subtract it as an additional expense, meaning as an additional cost of goods sold to get to $2,000. This is the slide I'm going to skip over. It's not real important for you to know. This slide merely illustrates why we can assume in our analysis that the purchase of inventory is always made for cash. And what this slide tells us is that if we overstate the cash purchase of inventory, that also understates the credit purchase of inventory for the same amount. And as a result, they cancel each other out, and therefore there is no change, no effect on net income in our examples. I would like to spend our remaining time reviewing the requirements for your degree and answering any questions you might have about your academic program. And this will also include what accounting courses you will be taking and my recommendation as to when you should take them over the next few semesters. The best place to look for the requirements is on the class webpage under General Information and click on Degree Requirements. This is the most up-to-date summary of all of the requirements. And so this is what you'll see. This is the section dealing with your upper division, business core, and accounting core courses. Let me blow that up for you. These are the accounting courses required by every accounting major, no matter which option you select, and I'll identify what I mean by option. None of you have yet selected an option. You won't until next semester when you are moved to the accountancy major. Right now, you're all pre-accountancy. Accounting 412L is a new requirement that I will explain in a moment. Business 497A is called the capstone course, and it's probably a course students know the least about. The prerequisites for this course are Finance 303, Management 360, and Marketing 304. But here's something you need to be aware of. You will not be allowed to enroll in 497A until you are in your last semester at CSUN. This is handled by the management department, and because of all of the demand for graduating seniors, they have made sure that only if you are graduating can you take this course in your last semester or possibly summer. There are two options in accounting. You may complete what is called the professional accountancy option or the information systems option, or both. Many of our students in the past have completed both options, but you need to complete at least one of these. And they have different requirements, as you can see. For the 3-unit elective, if you are in the professional accountancy option, almost all students take advanced auditing because of how valuable it is to passing the audit section of the CPA exam. Now, if you select only the information systems option, you won't have sufficient knowledge to sit for the CPA exam unless you also take the 400 level courses listed in the professional accountancy option. In other words, if you plan to sit for the CPA exam, not only would students who are in the information systems option take these 4 IS courses, so they'll take the second income tax class, the advanced financial accounting class, and the government and nonprofit accounting, in addition to advanced auditing, even if they're only taking the information systems option. If you don't plan to take the CPA exam, then you don't really need those other accounting classes. You can just take your IS classes. The accounting ethics course, Accounting 511, does not satisfy this 3-unit elective requirement. I want to make that very clear. Some students in the past have thought it does. In fact, Accounting 511 doesn't satisfy any requirement for your degree. It is only required for you to be licensed as a CPA. And I'll talk more about Accounting 511 in a moment. Okay, let's examine the recommended sequence of accounting courses you might want to take after you complete Accounting 350. Now, keep in mind, I'm only talking about accounting courses. Obviously, you're going to also be sprinkling in other courses, such as some of your upper division business courses. And maybe if you haven't completed all your GE courses, you may have a few of those still remaining. But these are only accounting courses, and my recommendation as to which semester to take them. Everything you see here that we've talked about is contained on the class webpage under course sequence. So first of all, not all students, obviously, complete their degrees in the same number of semesters because of work commitments and family commitments. Therefore, let's look at some of the possibilities. So the first example is if you complete your degree in 3 more semesters after you complete Accounting 350. Or It could be 3 semesters and a summer. So let's take a look at that. So the first semester after completing Accounting 350, meaning beginning next semester, these are the recommended accounting classes to take in addition to your other business or general education classes. Next semester, I'd recommend definitely taking Accounting 380, cost accounting, Accounting 351, which is your second intermediate accounting class, and 440, which is your first tax class. In the following semester, you would continue with Intermediate Accounting 3. You take your first auditing class, Accounting 460, and I recommend Accounting 412L. And this is a certification program for Excel. And I'll talk more about this course in a moment. Also, you can take Accounting 511. If you prefer not to take 440 in that first semester, you can take Accounting 511 and then take 440 in the second semester. So it's your choice. They're interchangeable. Let's talk about Accounting 511. As I said, an accounting course in ethics is required to be licensed as a CPA. This requirement can also be satisfied at a community college. Keep in mind, demand is always high for this course because only 1 or 2 sections are offered. Here are some reasons why it is better to take the accounting ethics course at CSUN. First of all, Accounting 511 has no class meetings. It is offered as an asynchronous online course. This means that you view videos of the professor's lecture and then take the exams. You complete Accounting 511 at your own pace, which means you can finish this course as quickly as the first half of the semester and therefore have more time for your other classes later in the semester. A graduate course, which is what 511 is, looks better on your transcripts than a 200 level course taken at a community college. And if you take more than 7 units other than Accounting 511 in a semester, Accounting 511 is free at CSUN. Remember, tuition fees increase at 7 units and remain the same beyond that. So after 7 units, you can take as many courses as you want and not pay additional fees. The next semester, you would take 441, that's the second tax class, 450, advanced financial accounting, 465, advanced auditing, and 475, governmental accounting. Accounting 441 and Accounting 450 can be taken during the summer when they are offered. If your degree is completed in 4 more semesters after Accounting 350 or 3 semesters in a summer, it would look like this. You would be taking less classes each semester, and this would be more the pattern of someone who is working, at least part-time, or has other commitments. And if you complete your degree in 5 more semesters, which would be more typical of a student that is working full-time, this would be what the schedule might look like, where you're taking a couple of accounting classes each semester, or maybe including a summer. And the 412L class could be taken at any time starting in semester 2. Let me talk about Accounting 412L. You are required to obtain what is called the Microsoft Excel Specialist Certification by taking 412L. Employers are beginning to place a lot of value on students having certifications such as this one. It is a credit, no credit class. The L stands for lab, even though it's not really a lab like you might find in the sciences. It's 1 unit. The prerequisites are IS 212 or equivalent and IS 312. The exam is given twice per semester. Before you take this exam, you must first take a practice test. You'll have all this information given to you when you enroll in Accounting 412L. There are no class meetings or instruction. However, you are given a tutorial to view that will help you prepare for the exam. So you view a tutorial and you take a practice test before you actually sit for the Microsoft Excel Specialist Certification exam.